Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome to the Joss Brown Podcast. I'm Philip Saunders.
And I'm Catherine Brown.
And today we'll be discussing what is an emergency fund. So, Catherine, what comes to your mind when you think of emergency fund?
The first thing that comes to my mind is debt, because I think so many people end up with credit card debt because they don't have an emergency fund.
Okay.
Yeah.
Yeah, absolutely. Yeah, for me, I would think of debt. Also, the thing that I wrote down here is disability insurance, because that can kind of play into it as well, depending on, we're getting pretty deep all of a sudden, but depending on how long the waiting period is before your disability insurance kicks in,
Yes.
your emergency fund can help out with that.
Absolutely. Yes.
So in terms of what is an emergency fund, generally we say 3 to 6 months of non-discretionary expenses, but you can also kind of play with that. With what expenses do you need? What expenses can you go without?
Absolutely, and doing cash flow planning can be really helpful with that, because then we can see what your actual expenses are and needs are. And if you have 2 people working, then maybe you can bank on both of them not being out at the same time. So maybe just 3 months might be okay for them instead of 6 months, because one person might continue to work. Another thing that I think about is the type of jobs people have. So if you are like a commissioned salesperson and your income is dependent on the economy, like maybe a real estate agent or a mortgage broker, then you might want to have 12 months of emergency reserves, because there might be a recession or something that, limits your income for a longer period of time.
Yeah. Mm-hmm. Yeah, and that's interesting you say that, because I see some small business owners also tend to have those bigger reserves, because they know that at any point their business might suffer from some unknown thing, and so they know to build up that cash and keep some safe money there.
Absolutely. And then when we have retirees, it's funny, they've been used to saving their whole lives, that they keep saving to their emergency funds even after the fact. And I'm going, wait, this $2 million you have over here is your emergency fund now, and it just doesn't click, right?
That's right. That's right. Yep, we've seen that. Yeah, so when we're looking to open an emergency fund, do we just go to Charles Schwab and click open an emergency fund? How do we do that? Where do we put that money?
Yeah, so most people, especially with the recent banking crisis, consider FDIC insurance when thinking about an emergency. So I always tell people it's good to have, a couple $1,000s somewhere that you can grab if there's a power outage. But then on top of that, the FDIC insurance comes into play with real banks. So I like Ally Bank and Betterment Bank and some of the other banks that have high interest rates, but they're also insured up to the FDIC limit, which is
$250,000.
Yeah,
last time I checked.
Last time we checked, yes.
It probably changes.
So
yeah, $250,000. The cool thing about, you said Betterment, is that some of these companies can use several FDIC limits, and so Betterment's is like $2 million, which is crazy.
Yeah.
But they're able to do that somehow.
Yes,
cool.
That is cool. And some of the brokerage houses, if you're at Fidelity or something like that and you have CDs, then those may be FDIC insured at different banks as well.
Yeah, that was something I noted too, is CDs. Do you normally recommend CDs for emergency funds?
Not usually, because there's a time limit on them, but depending on what the penalty is for coming out of those, maybe if they have enough saved up for a few months, it's okay to ladder the rest in CDs.
Yeah, absolutely. Yeah, but generally we think of maybe high yield checking or high yield savings, money market, maybe short-term bonds sometimes.
Right, exactly.
Depending on the situation. And like we said, it's different for every client, so that changes.
Yes, absolutely. So, the other thing people ask is, how much should they live on? Because that helps establish their emergency fund, right, is their spending habits. And, a couple of experts in the field have said it's good to try to live on 50%, right, of your take home.
Yeah.
And then maybe 25% in savings, and then another 25% in charity and things that you want but maybe don't need. Or opportunity funds. You like that word, right?
That's right. That's right. Yeah. That's something that I've learned working with you and Dan is you guys like to save about 25% of your income. And so just depending on the situation again, but sometimes maybe 10 to 20% in retirement, 10 to 15% in what we call an opportunity fund, and then 5% in an emergency fund. So an opportunity fund, we may do that on other podcasts as well. But when we max out that emergency fund and we have that number, that golden number that we wanted to reach, whatever that may be, then we start saving to an opportunity fund a lot of times. And so that means, okay, well, I've got these expenses that I need to have covered. They'll be covered. What can I do next? Maybe I want a house in the future, or I want a car a few years down the road. I want to get married one day, what have you. And so you save this opportunity fund that might be a little bit growthier and maybe invest in the stock market. And we've got another place to put that money and set aside for future goals. That's not retirement.
Right.
That retirement money you can't touch until you're 59 and a half. Well, how can we save for things in the meantime? And that's where we use the opportunity fund.
So a lot of people say you can't touch that money till you're 59, and that is a great general rule of thumb so that you aren't penalized when you take the money out. But can you think of some ways that people might end up taking it before 59, just so we can give the audience an idea of the exceptions to that rule?
Yeah, there are exceptions to that rule. So you can touch it before 59 and a half. If you don't use it for qualified expenses, then you're going to pay a penalty on that, and plus the tax. Let's say if it's a tax deferred account. But if you use it for qualified school expenses, your first home purchase, qualified medical expenses, and there may be a few others I'm missing there, then you don't have that penalty, and that penalty's waived. And there's a lot of other things rules that go into it. Let's say it's a Roth IRA and you've contributed that money, and it's not money that has grown, but it's that capital. You can take that out at any time. If you converted that to a Roth, that converted amount you can take out after 5 years. And so there's a lot of ways to kind of play with that and use that money. If it's a 401k, you can take a loan against it. And the cool thing I learned from you guys is that when you're paying that interest on the loan, then you're actually paying yourself, which is different.
It is different, yes.
But you can do that as well. So there are ways to access that money before 59 and a half. Yeah,
absolutely. I had a client once who he waited the 5 years after contributing to the Roth from 2000 up until like 2020. And then he retired early from the military, and he said, I want to get into real estate investing. And so he took out his principal right before he was 59 and bought 2 or 3 homes on the West Coast and is renting them out. So,
yeah. Wow. So another good reason to keep records of those contributions as you make them. Yeah.
Great.
Okay. Anything else?
No, I think that's great.
I think that's it too. Yeah.
Right.
If you got any questions, send them in. But thank you for listening to the Josh Brown podcast.
Thank you.